Debt is one person's liability, but another person's asset. Economist Paul Krugman is extremely correct here. The thing is, while debt might be a liability for most people, but for some it can be super beneficial. Now, when most people hear the term debt, they know it's better to run as far away from it as possible. Before we begin, let's talk about what debt actually is. Debt is something, usually money, that's owed by one person or an institution to another. These individuals or parties use debt to make purchases that they can't technically afford otherwise, and it's something that also has to be paid back with added interest. The most common form of debt is mortgages, auto loans, personal loans, and credit cards. This is exactly why people hate the idea of debt. They think of paying back these loans with hefty interest and start thinking that debt is horrible. And they're right, debt is horrible. If you use your credit card to buy a Chanel bag that you absolutely can't afford, you've made a horrible, horrible decision. But if you take on a debt to buy a residential property that you then rent out, you've made an amazing decision. And that's exactly the kind of debt the rich use to get richer. So without further ado, let's start talking about the ways rich people make money with debt. First and foremost, we've got margin investing. Margin investing or margin trading is where you buy and sell stocks and other investments with other people's money. In other words, you're borrowing money, going into debt only so you can invest. With me so far? Good. So next time you hear the word margin, think of the term borrowed money. Now, this is a great way to make some money. A margin account generally allows you to borrow up to 50% of the purchase price of the stocks you're trying to purchase. The remaining 50% has to be put in by you. This can work with other percentages too, such as 80-20, as long as you're the one putting in more money. It's extremely unusual that a margin account will allow you to borrow over 50% of the total investment amount. So let's say you have $50,000, you can borrow an additional $50,000 from your broker. Now, by putting 50 grand in, you can invest in $100,000 worth of stocks. Why is this a great way to make money? Well, let's say you invest in a company called ABC. ABC's share price is $1,000 per share, and within a few months, it appreciates to $1,500. Now, if you had put in just your own money, you would have bought 50 shares, and the value of your investment would have gone from $50,000 to $75,000. However, by using margin trading, you bought 100 shares, and the value of your investment went from $100,000 to $150,000. That's a neat $50,000 profit, $25,000 more than what you would have made otherwise. But it's not all rainbows and sunshine. You see, since you're taking out a loan to buy stocks, you're giving up some control of your investments to the firm that gives you the loan. If things don't turn out too well, if the investment tanks, then the firm can even sell all your shares without consulting you. Because this concept is built on leverage, which could be a double-edged sword. So you could make some darn good money if you implement the right strategies and tools to tip the scale in your favour. But one wrong choice and you could lose more money as well. On top of that, since it's a loan, you'll have to pay interest on them as well. Margin loans usually come with an interest rate of 6 to 8% annually, but it could also go as high as 10%. Margin trading can be a great way to get rich with debt, and it's also used by rich folks all around the world. But it's not something that a novice should be doing. Beginner's luck, sure, but that's still too risky, because one should be super experienced to make money with margin trading. By the way, if you're enjoying everything in this video so far, would really appreciate it if you could just like and hit the subscribe button. Another way the rich use debt to make money is leverage ETFs. An ETF stands for Exchange Traded Fund. But before anything, let's talk about how traditional ETFs work. ETFs are a type of pooled investment that operates like a mutual fund. They track a particular index, a sector, a commodity, or other assets. Think of the S&P 500. That's an ETF. However, unlike mutual funds, ETFs can be purchased or sold on the stock market exactly like a regular stock. ETFs don't generate massive, crazy returns. However, they're quite safe since your investment is pooled into multiple companies. This means that if one of those companies goes down, you won't lose all your money. But this also means that if one company does amazingly well and doubles its stock price, you won't double your investment. Now, a leverage ETF is a financial product that uses leverage. In other words, debt borrowing, to finance investments in instruments, like derivatives, to multiply the return of the underlying index. In simpler words, they take borrowed money and derivatives and amplify the return of a normal index. A normal investor might make 10%, but you can double or triple that amount using leverage ETFs. Now, remember how we talked about margin investing before this? Well, leverage ETFs are to regular ETFs what margin investing is to regular investing. It's just borrowing money to invest in funds, or they use derivatives such as stock options. So through the use of debt, you can increase the returns compared to the capital that you commit. This is a tool that's used by the rich to increase their income. But then again, this has the same downside as margin investing. If your underlying index moves in the opposite direction, the losses are amplified as well, and the investor will have to pay back the loan, plus the losses, plus the interest. Now, the third way the rich use debt to get richer is hedge funds. Hedge funds are a pool of money from super rich people, which the manager of the fund uses to chase high returns using unusual investing tactics. This means they seek out super undervalued or overvalued securities, and then take a long or short position based on how they feel the company's future is going to look. Now, the way hedge funds operate is to generate large returns that they purchase securities on a margin. Think about it like this. Let's say an investor buys stock for $1,000 and they use $500 of their own money and they borrow $500. When the stock price doubles, instead of doubling the money they put in, they quadruple it using debt. Now, of course, they have to pay that debt back with interest, but it works out well for the investor. But as with all sorts of investing using debt, there are downsides. Let's say the stock that the investor bought for $1,000 now drops to $200. In this scenario, the investor sells the stock for a $300 loss. However, the investor must pay back the broker the $500 with interest. So in reality, the investor incurs a loss of $800 plus interest and commissions. So while trading on margin allows the investor to make a lot more money than they would have, it also allows them to lose a lot more money than they would have. If the investor would have put in their own money, they would have lost $400. But since they used debt, they lost more than double the amount. Now remember I mentioned short selling just a minute or so ago. That's another way you can make money using debt. Short selling is a trading strategy that speculates on the decline of a stock's price. It's super advanced, so only experienced traders and investors should practice it. Let's say there's a stock you think is extremely likely to go down. You'll borrow the shares of that stock from someone and pay them a fee to do that. Let's say you borrow that stock for 3 months. Now that you have stock that technically someone else owns, you go to the market and sell it off. Now, as you expected, the price of the stock declines. So when it's time to return the person their stock, you just buy it from the market at the discounted price and give it back to them, pocketing the difference. This is definitely a great way to make money using debt, but it can also get super risky. Because at the end of 3 months, no matter what the price is, you have to return the stock. So if your calculations were wrong and the stock price increases 3 times, then you have to pay the difference too. A great example of short selling gone wrong was the entire GameStop Reddit saga, where the firms that held short positions on GME lost tons of money because of the rapid increase in the stock price. If all this sounds too risky for you, or if it's too technical, then you can always use debt to start or expand your business. This is the most common way for rich people to make money with debt. Yes, there are downsides to getting debt to start your own business, but there are also benefits to starting with little money and then using debt to fuel growth. Debt allows for a business to accept capital that it wouldn't have access to normally, enabling it to invest in growth or cover unexpected expenses. So, let's say you've got an online store and your orders are increasing by the minute. However, you can't fulfill half of those orders since you don't have enough in your inventory, nor do you have the capital to purchase. You can take out a loan, buy new inventory, and then pay it off with the money that you make. And at the same time, it's more flexible than equity financing as well, since you don't have to give anyone ownership of your business. This means you can make your own decisions and you don't have to be pressured to meet profit quotas quarter after quarter. The bottom line, folks, is that debt can be horrible, but if it's managed properly, it can allow individuals and institutions to get extremely rich. Well, folks, with that said, let us know in the comments what you think is the best way to use debt to get rich. See you next time.